Welcome back to our finance mini-series. I'm Dr. Robert Clark, and today we're diving into the basics of financial terms. Obviously, it would have made sense that I recorded this as part one of our series, though nevertheless, here we are. All right, let's start with assets. Don't let this word intimidate you. It's much simpler than it sounds. Assets are simply everything a company owns that has value, from the building it operates in, to the equipment it uses, to its cash in the bank, to its trademarks and patents. But here's an interesting part. Assets can depreciate over time. Depreciation is the process by which we account for the wear and tear on assets. For example, machinery, computers, buildings. We gradually deduct the cost of these assets from our financial statements over their useful lives. This provides a more accurate picture of the company's value, though we need to remember that not all assets depreciate. Some, like land, may actually appreciate over time. Moving on to liabilities. In simple terms, liabilities are what a company owes to others. This can generally include loans from the bank, money owed to suppliers, or wages due to employees. Essentially, these are the financial obligations a company needs to meet. Our next term is equity. Now, equity is the difference between a company's total assets and its total liabilities. Think of it as the true net worth of the business. It represents the amount that the owners or the shareholders would theoretically receive if all the assets were sold and all the debts were paid. Now let's talk about two words that you've probably heard before: revenue and expenses. Revenue is the total amount of money generated by the sale of goods or services relating to the company's operations, and expenses, on the other hand, are the costs incurred in the process of generating that revenue. Now, where do we actually record all these financial elements? That's where the balance sheet and the income statement come into play. The balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. It shows what the company owns, owes, and the amount invested by shareholders and accrued to shareholders. On the other hand, the income statement gives a summary of the company's revenue, costs, and expenses incurred during a specific period, usually a fiscal quarter or a year. It gives an idea of the company's profitability during that time. Okay, I wanted to provide brief comment on the interplay between some of these terms, especially between the income statement, so revenues and expenses, and the balance sheets, assets, liabilities, and equity. Firstly, imagine a company is selling products. The revenue from these sales would be recorded on the income statement. If the company makes a profit, that is, revenue is greater than expenses, this profit gets added to the equity part of the balance sheet because it increases the company's value. If the company makes a loss, it reduces the equity on the balance sheet. Also, when a company makes a sale, it might receive cash or might have an amount owed to it, which is called accounts receivable. This is an asset and goes on the balance sheet. But if a company buys something on credit, it's recorded as an accounts payable, which is a liability on the balance sheet. Let's illustrate this with a hypothetical, using the example of Homer Simpson's tech company, Compute Global Hyper Meganet, which I'll abbreviate as CG. Now assume that CG has just released a new product. They sell 10,000 units of this product at $500 each, leading to a revenue of $5 million. This revenue will be recorded on the income statement. Let's assume their production and operating expenses were $3 million for the same period. So they made a net income of $2 million, $5 million revenue minus $3 million in expenses. This net income of $2 million will be added to the equity section of the balance sheet. Further, suppose CG received $4 million in cash from customers and that $1 million is still owed to them. Then their cash assets, part of the balance sheet, will increase by $4 million and they will have $1 million in accounts receivable, which is another asset on the balance sheet. Meanwhile, if CG bought $1 million of supplies on credit during that time, their accounts payable, a liability on the balance sheet, will increase by $1 million. So what I'm trying to show you is that there's this continuous dance between the income statement and the balance sheet. Every transaction, whether a sale or a purchase, influences both documents in different ways. And understanding this can provide valuable insight into a company's financial health and performance. Well, that's a lot of terms, isn't it? But don't worry, the more you delve into the world of finance, the more these terms will become second nature to you, as will their interplay together. Remember that mastering these basics is your first step towards financial literacy, and that can open the door to many opportunities. That's it for today's episode on the basic financial terminology. Please stay tuned for more episodes in our finance mini-series, where we'll break down even more complex financial concepts. But until then, keep learning, stay focused, please subscribe, and I'll see you next time. Thank you.